everyone, I'm John, and today we're talking about long-term investing with the Little Book of Common Sense Investing. Throughout history and simple arithmetic, it's a winning strategy to own a share of all the most popular companies in the United States. You can do this at a low cost and also capture the return that you want in the stock market. Many of these businesses generate you what's known as a dividend, money that pays you for investing in them. This is a really simple strategy. You buy a fund that holds the all-market portfolio, and you hold it forever. These funds are known as index funds. And you can think of your portfolio as kind of a basket, and all the stocks that you have as eggs in that basket. An index fund actually just mimics the US stock market. And because of this, it really eliminates you having to pick individual stocks. So the only risk that you have at the end of the day is the stock market risk. This is the magic of compounding investments. Because you get paid a dividend with the index fund, you can also reinvest that back into buying more shares, therefore compounding your investment. Now, in this book, Jack Bogle actually talks about a lot of common sense financial wisdom that I really wish that I knew when I was a little bit younger. The first thing is that you need to get rid of all of your helpers. You don't really need a financial advisor, especially if you go with a really easy strategy like index funds. That's because you want to be able to reap your own pie, and you don't want other people to take slices of your pie. He then talks about what successful investing is. And successful investing is basically investing into businesses that will pay you a dividend and therefore wanting you to invest more into their business. He then talks about the fees of being too involved in the stock market. This happens because your investment activity can increase or decrease depending on when you are buying or selling stock. And with more buying and selling, the more transaction fees and also the more tax burden that you might have at the end of the year. So instead of doing this, we can just set something and forget about it, therefore only reinvesting and having very little activity towards our stocks. Based off of the performance of the index fund, it's been anywhere from 8 to 13% of return every single year. Now, this is combined with your investment return and also your speculative return. So this is your total stock market return. There's a great point in this book about how the stock market is actually just a distraction from investing. It's more of a game that we are playing rather than using it as a tool. So you have things like the expectations market, and that's all about speculation. The real market is really about investing. This is that famous quote by Benjamin Graham about, in the short run, it's a voting machine. In a long run, it is a weighing machine. So the true investor will not actually care about any speculation. They'll actually only care about their dividend returns. And this is what brings up the term Occam's razor, which is just when you have a lot of different choices, you choose the simplest one. So owning stock in the stock market is a winner's game. You're actually in the game. But trying to beat the market, it's only a loser's game. And the reason why it's a loser's game is because beating the costs alone is really hard to do. So even beating it before costs, it's a zero-sum game. Beating them after costs, it's just, you're gonna lose. So when returns are kind of at the top of your mind, this is where time comes in. Where your returns are concerned, time is going to be your friend. But where costs are concerned, time is going to be your enemy. So this is kind of like saying if you put 100% of the capital up for an investment, you should be taking 100% of that risk. But it's very possible that you can earn 40% less of that investment just because you let somebody else choose for you. The one thing you should take away is that costs will determine your success or failure with your investment. And a low-cost index fund really is the best of both worlds. This is because you will get your fair share, whether it is positive or negative in the market. And there's also very low fees to even be in the fund in the first place. Now, first, what you want to know about fees is that there's a thing called the expense ratio. And this ratio is basically how much of the fund is going to be allocated to managing it. So for things like mutual funds where they're managed by other investors, you're going to have a higher expense ratio. But for index funds, there's very low expense ratios because they're not really managed by anyone. This is because in mutual funds, they will typically pay the investor first before you get a slice of the pie. This could lead to a lot of different things like sales whenever you purchase a share, or even when that investor decides to rebalance the fund, there's going to be a lot of transactions that have fees associated with them. You could typically say that higher costs will lead to lower returns. The problem with mutual funds is that these funds typically have a high turnover as well, meaning that they might just stop the fund altogether. And in the last 25 years, a low-cost fund actually returned about 9.3%. A high cost, however, was only returning 8.3. So you can see that there's a significant difference by just minimizing the costs alone. So your expense ratios are going to help you make a better decision of where to invest your money. And if you take away from this video, low costs will typically beat high costs. Now, expense ratios are actually used as a predictor. The lower the expense ratio, the higher performing of the fund. In other words, don't let other funds confiscate your dividend return. There's going to be a lot of choices on the stock market for you to choose what to invest into. You will see a lot of money that flows into certain funds after good performance. You'll also see a lot of money pour away from funds when they have bad performance. But the index fund actually beats both of these. You own the whole stock market, and therefore you can't necessarily lose. You own the whole stock market, and therefore you have a winning strategy. Now, you can also balance your portfolio in terms of bonds and stocks. A balanced portfolio is typically about 60% stocks and 40% bonds. And that's just making sure that you get about 3.6% over the next decade. Now, an index fund has a lot more benefits as well. It can protect you from being financially devastated. This is because the index fund is self-correcting. Good businesses rise up into the index fund, and bad businesses will fall out of the index fund. So if you're investing for a lifetime, you have two basic options. You can choose up to 3 to 4 different managed funds that you have to hope that will do really well in the market until you retire, or you can invest into an index fund. You have to be able to ask yourself questions, especially for the future. Like, how long will the fund manager actually manage the fund? If the fund grows too fast, will a strategy change? Will there be higher expense ratios to keep up with the growth? And ultimately, will the stock market actually care for the strategy? So you can do your best to actually diversify here. You can minimize all of your investment expenses, and you can just focus your emotions on one thing instead of the many things. You can own an S&P 500 index fund. It's really that easy. There's a lot of history comparing other managed funds to the S&P 500 index fund. And among 20 of the best performing ETFs, 19 failed to meet the expectations of an index fund. The real money to be made in investment is simply by buying and holding securities. And these securities will typically give a dividend, which will then increase their value. And at the end, we talk about the recommendations for investing. If you're young, you want to take a bit more risk on, so you might be 80-20 stocks and bonds. If you're older or getting closer to retirement, you might be 60-40 or even 50-50. Now, you have two main factors in determining those ratios. One is your ability to take risk, and the second one is your willingness to take risk. When you put money into your retirement account, you're usually going to get put into a thing called a TDF, a target date fund. You should really look under the hood of what a TDF is, because many TDFs actually hold on to managed funds, and therefore they're actually pretty pricey in terms of cost. If your TDFs, however, invest in something like an index fund or an ETF, then you should be okay and you should be able to use that. But otherwise, you can think about how you want to invest that money as well. And if it's no surprise by now, a low-cost index fund is probably your best bet to go with. And this strategy should work for just about every family out there. Although it might not be the best strategy ever, especially if you're interested in stock market and investing, there are a number of way worse investment strategies out there. We should know that we need to be investing as soon as possible. We need to regularly put money away, and we also need to know that investing will bring risk. But we should also know that not investing will bring even more risk later down the line. If you want to simplify your risk, only have the market risk. Stop overpaying other people to manage your money. Find an expense ratio that is low enough for you, and go out there and invest. We never know what will happen in the next decade, and therefore we should be prepared for it. You can make sensible investment choices by just allocating your assets in a strategy that you think makes sense. But with intelligent asset allocation and sensible investments, you'll be able to pave your way to financial freedom. And that was the little book of common sense investing. My name is John, and we will see you next week. Take care.